with the local market open, let's get some analysis and observations there, particularly what we're seeing out of the US with earnings. James Gerrish joining us from Shaw & Partners and Market Matters. James, a very good morning to you. Thanks for joining us. All right, so we are moving in the right direction in the first few minutes. That's, as I mentioned, off the back of what we saw on Wall Street, which was pretty flat. Does that surprise you, given we're getting these earnings results coming through?
Yeah, good morning to you, Andrew. It was a pretty lackluster session over in the US market. It was not just in the equity space either. It was right across bonds as well as commodities. So, sort of understandable given the recent rally the market has had. We're sort of in no man's land where we're sitting here. Stocks are up. But it's probably been a begrudging rally because positioning is still fairly much on the, fairly heavily skewed towards the negative side. And then you've got earnings releases coming out from for US quarterlies, which overall have been better than expected. We saw the banking results come out at the back end of last week, which were better than expected, and stocks generally rallied on the back of that. So, yeah, a little bit of a tepid session, not much interest right across all asset classes, Andrew.
Well, in the States then, with those earnings results we've seen, which has mostly been the big banks, we did also get Netflix out overnight as well. What are you taking out from that? Because, I mean, the expectations were quite low. Therefore, is it surprising we're getting some of those, most of being beats, in fact?
Markets are all about their reactions relative to where expectations lie. So you touched on Netflix there, and that was an interesting one overnight. Subscriber growth numbers came in below expectations for the quarter, but they did point to better earnings for the second half of the year. So that was an interesting market reaction post-close. So the stock was down about 10% straight after they released their numbers, but bounced pretty aggressively and was around flat by the time of the after hours market settled. So you may mention the banks. They were having, they're doing better in terms of costs, and they're doing reasonable in terms of margins over in the US. That's a positive read-through for our own banking sector. So, look, I think you're right in terms of market positioning. Obviously, analysts were expecting a decline in earnings, and then fund manager positioning was also bearish. So we've got the highest level of, or the lowest allocation to equities versus bonds since 2009. We've got high cash levels according to recent investor surveys. We've got this, the most anticipated recession about to come upon us. So, you think about all those things stack up to say investors are pretty bearish in their positioning and their thought process at the moment. So that does set up the chance of upside surprises, if you like.
Yeah, you talk about that market positioning. Interesting, you talk about that looming recession as such. We heard from Fed member James Bullard overnight saying he's not seeing it. He seems to be a little frustrated that the market has essentially priced that in. Of course, this is as we head towards the next Fed meeting in May, where a 25 basis point hike has been priced in. The question is what beyond that? Similarly, I guess, also what we're expecting from the RBA in terms of its next move. How are you looking at that market positioning as a result?
Yeah, it's pretty fascinating, Andrew. So, the market, he's right in terms of what the dislocation between what the Fed is saying and what the market is pricing. So, the Fed is saying, hang on, we've got an inflation issue that's persisting. We've got really tight labour markets. We're going to need to continue to raise rates. The market is saying, there might be one more and done, but we'll see a deeper economic contraction at the back end of the year, this side of Christmas, and that'll force the Fed to aggressively cut interest rates. I mean, you look at the US 2-year yield, it's trading at 4.2, but the 10 years trading at 3.58%. So you can clearly see the market's pricing in tougher economic conditions ahead, and that probably goes against what the Fed has been trying to push forward into markets. But my interpretation is that bond markets have probably moved too aggressively pricing in cuts before Christmas. So our short-term view is that bond yields probably go up in the near term, and that could put some pressure on those interest rate sensitive sectors of the market like technology, etc. So we've been overweight that space for the past 6 months or so. I think that trade is now maturing, and we've started to lighten the load in terms of our technology holdings in portfolios, Andrew.
All right, more broadly, how are you positioning yourselves at the moment. Interesting. I'm just looking at what's moving on the market at the moment. Certainly across the resources sector, it's glowing green. Is there a bit of a China story here as well, given those that data we saw yesterday?
Yeah, that was better economic data coming out of China, so naturally that should be supportive of the resource companies in Australia, and we're seeing that on the market this morning. Fortescue's opening up sort of 2% higher. So yeah, that's an area that I think we're looking to increase our positioning towards. So you think about technology exposures being quite high. We've started to reduce that, and we are picking off some of the weakness that's playing out in the resources company. So it fits with our positioning at the moment, Andrew. So that's a positive. In terms of obviously banking, the banking space has still got some challenges. The inverted yield curve that I just spoke of throws up some challenges for bank earnings. So I think that's something the investors need to remain cognizant of.
How are your cash levels at the moment? You've sort of got a bit of your powder dry there.
Yeah, it depends what portfolio you're speaking of. So we're generally around 7 to 8% cash across portfolios, a little bit less in our income sleeve. But you think about, that we do that just to have a little bit of optionality. So if you think about if you ask about how I'm thinking about the market at the moment, I'm more on the sell side, lightening off on equity positions rather than going in there and going maximum long the market. So I'm a more inclined seller of strength right now after the pretty significant rally we've had in equities. I mean, we're only 3.5% below all-time highs for the ASX. I know there's a heap of there's reasons for that, and the market is bearish. And I like to be long the market when the collective is more bearish, because I think surprises generally happen on the upside when that's the case. But right at the moment, I think I'm a little bit more keen to take positions off into strength as opposed to set new ones.